Wall Street strategists say investors are becoming more concerned about Fed independence as President Trump seeks to impose his will on the central bank. JP Morgan analysts wrote to clients that, quote, markets have become more concerned over Fed independence as there are signs of a Fed inflation trade. Goldman Sachs analysts also noted growing concerns around Fed credibility. Let's get Morgan Stanley's take. Joining us now is Mike Wilson, who is the firm's chief U.S. equity strategist and CEO. Mike, thanks for joining this morning. Great to see you.
Great to see you.
So is this showing up in markets at all? At least on a headline level, there's been little drama.
Yeah, I think so. I mean, we've seen a little bit, maybe some term premium. I mean, in the bond market, I would say in the equity market, we haven't seen a major rotation yet to what I would say overly concerned about inflation running away from us. But this is part of a broader strategy. I mean, I think regardless of what happens with this particular event or, transition, the Fed and Treasury are working closer together and have been working more closely together because we have too much debt. Okay, and they've been doing this for, I would say, several presidents' terms and Treasury Secretaries' terms. And as I've been saying for quite a while, the Treasury is captured by Congress, right? Their job is to fund whatever Congress decides to spend. And the Fed, in many ways, is captured by Treasury's needs. So we've seen them work hand in glove in the past. And so that doesn't mean that they're going to be manipulated and do something that's really crazy. But I think the Fed does have an obligation to help the government fund itself.
This is so interesting because there has been so much noise around Fed independence. Of course, we're going to get Steve Myron's hearing today in Washington, and their concern about Fed independence is what I'm basically hearing from you is it's not a concern that you need a Fed who helps run this economy hot in order to tackle the deficit.
That's right. And by the way, I'd be nervous if the Fed wasn't somewhat totally independent because we do, the Fed needs to work to help us get out of this deficit problem. By the way, this is a bipartisan problem. This is not a Republican problem. It's not a Democrat. It's an American problem. We have too much debt. So the Fed should be working more closely with the government, with the administration to try and get our way out. And running the economy hot, as our note was titled this past week, is one of those strategies. So higher nominal GDP growth, maybe let inflation run a little bit hotter for a period of time, and then do more investment through tax incentives, and then hopefully you can kind of grow your way out of this debt.
Some people would say, though, that the risk with that is that you get the long end of the yield curve doing what it has been, and that is going higher, bumping up around 5%. What does it mean for equity outperformance? If running it hot helps equities, but potentially hiring long-term borrowing costs mean that it has the opposite effect of helping to loosen policy.
Well, that's right. And that's why I think the Treasury and the Fed together need to keep back-end rates lower, as they have in the past, right? So financial repression is not a new phenomena. There's different ways to do that, whether it's QE, yield curve control, they call it different things. But I'm pretty confident that if yields were to move back towards 5%, they would find a way to get them lower again.
So fiscal dominance means that in any of these circumstances, equities do well. Is that fair?
And to a point. I mean, look, they were priced for a lot of bad things in April, right? They were priced for a recession, which, by the way, in my view, I think we experienced a rolling recession that troughed in April. We've written about this extensively. And now we're into the next recovery. I call it a rolling recovery. So it's not going to be straight up for every sector. But the one part of the economy or one part of the market that has not really performed yet is the interest rate sensitive parts of the economy. Housing, areas that require borrowing costs to be lower. So that is the next stage of this. And I think, last week or 2 weeks ago, Jackson Hole, that's the first step to the Fed becoming more dovish. This is going to play out over the next 6 or 12 months. One of the reasons why we're still pretty bullish over the next 12 months.
Well, one of the things you write about that I think is so brilliant is this idea of a presidency that's kitchen sinked, much like CEOs who kitchen sink, get all the bad news out of the way. So the sequencing, is the bad news done then, Mike? Are we entering the period of deregulation, of tax benefits, and that adds rocket fuel to this equity market?
Absolutely. I mean, I think from a policy standpoint, the bad news is behind us. They sequenced it with a kitchen sink quarter in the first quarter that created a trough. And if you look at the policy, sort of initiatives from the administration and all the rhetoric starting really in the middle of April, it was all pro-growth. They really flipped the switch. And I think that was intentional. I think that's a very out of consensus view still. So, yeah, it's going to lead to, I think, somewhat of a boom next year in CapEx, in earnings, corporations earning more money. They get a tax break now from the recent tax bill that was passed, and that recirculates into a higher velocity economy. The missing piece, once again, in this recovery is lower interest rates. That's the next phase.
But if it's all really concentrated in the first half of 2026, which we know the one big beautiful bill is, what happens when some of that juice starts to run out? When some of the CapEx spending on AI starts to run out? Does it mean a more challenging time at this time next year?
Well, that to be determined. That's a story for another day. Right now, we're focused on the next 6 or 12 months. Now, I do think there's some risk in the short term for some corrective activity because it's been straight up. And I wouldn't even be surprised if we get a sell the news on the first Fed cut, like maybe back-end rates get away from them a little bit.
And you'd be buying those dips.
I'd be buying those dips, but I think over the next 6 to 12 months, I mean, it looks pretty darn good from an equity perspective.